None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. It is Monday. We got a holiday week ahead of us, 4th of July. Looking forward to a long weekend, I guess. Although I usually hate them because it usually means we have something to do with work that I can't get done because of a long weekend. But anyway, not a lot going on. Last week was pretty quiet as it goes. There was it was pretty quiet. We're down, what,
0.1%.
Yeah, so, but we saw a little recovery after some early weakness in the beginning of the week, but not a lot going on, and we're continuing to see, I guess, summer days on summer doldrums unfold right in front of us. So anyway, what we're going to do today is a typical schedule that we go through, but the ultimate, I guess what we're going to talk about is we're only going to do 2 shows this week because of the holiday, and we've already gotten a lot of returns on some emails, auto emails, right, Mitch? We got a bunch of folks that are out of town, which I was able to do some of the stuff you guys could do. I'm always envious, but the so we're kind of hanging here this week and making sure the show continues on. So we're going to do today and we're going to do Thursday so we can recap some of the employment issues and things of that sort going on. And as far as the market's going, up 0.15 on the S&P right now, pretty quiet. So not much you can say there, right, Mitch? I mean,
yeah, it looks like everybody's already hitting Hawaii or wherever else for vacation this week, or I guess celebrating 4th of July a little bit early.
Yeah, that's, I know one advisor we talked to is there. Let me just look real quick, Mitch. I'm going to give you 4086. Okay, so and then so we're kind of casual today. We're trying to figure out we need some entertainment. Maybe we should play a video or something to entertain everyone. It is pretty quiet. Maybe we can come up with a couple movie clips. Some old. I was looking at some old cowboy movie clips while I was working this weekend. Some of the famous shootouts that there was, like in Tombstone and what was it? One Clint Eastwood, my favorite one at the end. Anyway, let's. So let me just do one thing here for Mitchell, and so we're going to go through our typical stuff as far as going through what the database did, which was about what the market did, which was nothing. I think we had 82 positive trades. We had so we had several hundred transactions, but net it was 82 changed in the database. So our bullish percent continues to be around, I think it's 69.27 to be. I think that's exactly the number because I was writing about it last night in commentary. In commentary, I talked about a couple of things which I think maybe are significant enough to discuss. Is the really this week is about unemployment. Everything's gonna be focused in on ADP on Wednesday, and then Thursday will be the unemployment numbers, which are expected to be unchanged. I think 211,000 new jobs, and I think ADP is looking for. Let's see, I've got the numbers here right now. ADP is looking for 231. So there's a continuation of the job creation that continues. The United States of America is an amazing machine, to say the least, and it starts to get rolling. It'll keep going. Even though a lot of these jobs that are being created aren't higher end jobs, they are jobs, and it all counts in the end. So people like the discount. The quality is one thing, but people getting back to work is just a good thing, and especially after all the stuff that we've been through over the last several years.
Yeah.
Anything else out there, Mitch? We had housing come out 6.1 instead of 1% expected, so that was a better number. And people are fairly excited about that. There's a couple other housing numbers coming out this week. What was that? Pending sales? Is that what that was, or was that?
Yeah, pending home sales.
Yeah.
Consensus going into it was 1%. It came in at 6.1%. That's
Right.
a pretty hefty jump.
Yeah.
The Chicago PMI also came in. Consensus was 64. Actual was 62.6. So, I guess that's right in line with expectations on that. And other news items, the Supreme Court's handing out a few different rulings, and of course the market doesn't really care about any of this today. It's essentially flat, almost completely unchanged for the day.
Yeah, and I noticed that most of the economic numbers, like the PMIs and different elements that are coming out this week, everything was expected in general to be a little bit less than the previous report. So economics, this next second half of the year was supposed to be the acceleration part of the economy.
Right.
So we'll have to see what happens there, but right now all the expectations are the opposite.
Yeah, after first quarter, the GDP being what it was, a lot of people were expecting that the economy would really ramp up the next couple quarters to make up for how slow it was because of the weather.
Yeah.
And we'll see if that's the case, but so far it doesn't seem to be showing signs of it.
Yeah, snow. Actually, funny thing is I saw snow one time last winter, and that was in Houston, Texas, of all places. They had to de-ice our plane because of global warming. So anyway, they were really short on de-ice the whole thing. They had one truck that could de-ice a plane, and we were in a 45-minute wait because they can only do a plane at a time. They weren't really set up in
Texas.
Deep south in Texas on the Gulf of Mexico for snow. So it was kind of interesting. So all right, let's go ahead and get ready and go ahead to some of the analysis here. I've got the S&P weekly going here, and in fact, I think I'm going to see if I can just get a screen that has just the charts on there so we can see the PPMs. Like I said, not a lot going on. We're now down 0.8 on the session, just kind of floating along. Like I said, I expect this to be an extremely boring market this week as we unfold. There's just not anything out there really to drive until we get to some of the numbers in ADP and employment on Thursday. And so, yeah, we just don't have, there's just nothing really to look at, but we'll go ahead and review the PPMs that I always talk about. The PPMs continue to have a positive mode here on the weekly. We got 0.51 on PPM 1, 4.1, and 3.6. So I mentioned this slightly in the commentary last night, but the trends are still expanding, and these are pretty good numbers on a weekly basis. They can get more robust than they are, but we're into the maintenance phase of this trend, which means that the moving averages are going to be rising underneath the pattern at 0.5%, roughly about 0.5%, at least for PPM 1 and 2, which is the 10-week and 21-week moving averages, and then the 40-week is rising a little bit better than 1/3 of 8%, which has really got not a lot to, there's not a lot there other than there is a trend and it is up, and that's what's unfolding. We've seen these same type of numbers literally all the way going way back into 2013. While the market was stair-stepping its way up, they continue to. It's the same characteristic of this trend that we've had before. And I always quote, expect more of the same until the market shows you something different. It's just not showing us anything different, and the trend is up, and it's going to keep creeping and crawling. But in the background, when you're looking at 18,300 some symbol in our database, there's some areas that are moving around, and maybe we can find some things that are going on. I saw a story on CNBC that had like the 25 stocks you shouldn't have missed this year, and I started to tell Mitch about it, see if we could find a few of those. But yeah, we'll try to do something entertaining today the best we can. So, but the weekly trends are in place. Today is a monthly close, so this is pretty significant from those charts. And I mentioned that we are looks like we're going to close around, I can't imagine much activity going, but let's say we're going to close over 1960 today. Last month we closed at 1923, so this is a new historic monthly close. And momentum, let's go over there and take a look at this. Momentum is continuing on the upside. You can see that his chart's going off the top here. It just continues to move up toward the highs. Probably one of the more interesting patterns that I see that are unfolding here, and this is what's going to come into question here as we move forward, is that the trend is up. We had a reversal way back here in February when we saw the market declining fairly sharp, and the Chicken Little was running around saying the sky was falling, and everybody was starting to get really nervous because we were at historical highs there. We saw a big monthly reversal. You can see it here. Let me put it on a whiteboard just to talk about this, because this is probably one of the few patterns out there that are suggesting that there's something significant. So I draw a big arrow up there. This was the reversal. Since then, while the market has been not robust going vertically after that reversal, we have seen since that reversal, this is the 4th month in a row that we've seen higher prices, and there's a good chance we're getting at least one more month, and the possibility of getting as many as 4 more months in this pattern, and that would bring us into into the fall, October, which has a tendency to be kind of a topping period. And because of the rotation has happened, if you recall earlier in the year, including talking about the outlook that we did early in February, is the expectation was for a second quarter top. Well, things changed since then, and we saw a complete rotation in our database, which is now at, like I mentioned just a little bit ago, at 69% bullish. This is a sign that the market has once again regenerated itself. It's probably as soon as I see, actually tomorrow afternoon, so when we come in on Thursday, hopefully I'll remember to look at the monthly chart just one tick. So I need a bar of the next new month to see what kind of how momentum's being affected, even if the prices are somewhat unchanged or around where they have been. I really need to see that once we'll be able to see whether the acceleration is going to continue. In the case of a 10-month moving average, it looks like these lower prices drop off are going to continue to drive the momentum to a much stronger. But so we should see one more month for sure. So the month of July is likely to be a positive one, and there's a potential of going into the end of October driving into what I call an 8-bar pattern on a reversal breakout like what we had. So not only did February reverse, it actually was a reversal that closed into a historical high from a monthly standpoint. So it was a pretty significant event. So it was a breakout event, and the market has been accommodating. So PPMs on the monthly, we talked about this before, very robust trend, 182, 149, and 106 PPM 1, 2, and 3. So all three trends way into positive trend area. The characteristics on these longer term charts, usually when you get below 0.5, you start to see some flattening and the trends getting somewhat vulnerable, but we're at 182. We're nothing in any of these three indicators are suggesting that we're even close to that. So we kind of bounced around a little bit because of the end of the month. But let me, I didn't mean to do that. Let's see here. Where'd it go? There we go. I think I installed some new software. Obviously, the update doesn't work like the old piece, which is always handy, right? So as we look, let me go into the daily charts here. And you'll see, I talked about this before, mentioned in commentary, the upward objective right now, the very short term is the 1973 to 1989 level. I think we will see that this week, probably due to the employment numbers or something. It looks like they want to be, this thing wants to be positive. Of course, we saw a negative 2.9 GDP and all kinds of negative numbers, and that was good enough to make the market rally back. So they obviously really don't care about much other than they believe in the Fed. They go to the church of the Fed, and they're faithful believers that this is going to continue on until the Fed decides it's not going to work that way anymore. And I do believe there's some risk in that overall attitude, but not for the moment, not based on the trend. So we should see, if you looked at the weekly expectations on the patterns, resistance 3 is 1982, and extreme for the week is 1989, and we have resistance 2 at 1975.35. So we're most likely going to see that level, and there's a very small chance that we're going to go below support 1, which is 1954.20, which is only about 6 points below that. The next level is 1946. I don't see us getting there at all. I think we're going to see, if anything, maybe a move down toward the S1 on the weekly, toward that 54 number, but I don't think we get through that. If we do, it won't last but for a few minutes. And then most of the pattern on the upside looks like we should see at least the 67 to 75 level, and I wouldn't be surprised to see us print into the 82 to 89 level, depending on what comes out this week from the employment situation. One quick glance here at two more charts here, as this is the hourly graph, which has been absolutely flat, but I want to go to my favorite charts here and look at the hourly 24-hour futures chart. These cycles have realigned and are pretty in sync right now. We had a cycle come in earlier this morning, pretty much around where the low was, and now we're into a pattern that looks like it wants to bottom out sometime before we come in tomorrow. So as long as the pattern stays relatively positive for the session, which it looks like it will, we're, of course, I don't know what you call positive, up 0.14. It's not really positive, but we'll go with that. The 5-minute cycles have misaligned just a little bit. There's a couple that are coming in, but we're looking at, it's interesting because if you remember on Friday's show, I talked about it, there was a good chance of the market bottoming and rallying into the close, and it's exactly what they did. They managed to pump the market up by 3.74, and most of that rally happened in that last hour. And interesting enough, this 5-minute cycle, you can see here it is over here, over on the left hand on the screen here. Matter of fact, I'm right in the way, so let me move that for a second. But you can see that cycle came in right here, which was that blast off in the markets here this last hour. We saw a nice little cycle bottom and it come in. So we've got a little earlier cycle coming in from the standpoint of today. It looks like we're probably only about an hour and 20 minutes out before the next cycle comes in. So we'll see if there's anything that's going to move this market or not. Most likely we're going to stay in this very flat line pattern that's been unfolding for a little while here. Couple things here, just a final touch on the S&P 500. We're looking at the weekly webs. We've got the volatility index at 1145. We did print down the other day down to 1087 again. I've talked about this VIX index, and I think we're not going to be able to really claim the complete complacency trade until we see a single digit index here, and I think that will happen at some point over the next couple months, where we'll see maybe it get into the nines, and it just looks like, you know, life is always going to be good. And when that happens and volatility gets really low, then we're going to see that. I forgot to look at the index. Yeah, we're at 1360 on the 3-day right now. So there's not, it's expanded. It got down to 580 something last week. So not a lot going there. So that is about it from the index overview. I think what I'm going to do here is I'm going to bring Mitch and I back on the screen while I check out something here that I think I forgot to do, and I did. So I'll do that off screen. So Mitch, why don't you talk a little bit, and I'll bring up the screen here in a minute for.
Well, like you had said, there's not a lot happening. I sort of view this as the market's like a fat old man floating down the lazy river at a water park. I mean, it's just barely moving along, slowly making its way downstream. And today, I mean, we're still unchanged. It's really interesting to see how the market's changed. A week or so ago, we had talked about some of the pig countries and how things have recovered overseas in those areas. And one of the things that I think would be good to touch upon today, especially as we start going through the globe at a glance, is the other investor favorites from a few years back, the BRIC nations. It's been really amazing to see how those areas have really grown over the last quarter, especially. So I'm going to go ahead and pull that up right now. I guess just to go through all these different charts, as you can see, and as Bob mentioned earlier, the net buying was about 82 symbols out of 18,000. That's negligible. You can take a look at it on the fund side. You'll see that really the only sizable activity that we saw on the fund size was actually on the alternative space, and really what those were the bear funds selling out of those funds. So just like we saw the buys over the last few weeks, now we're seeing the sells on some of these bearish funds. So if we go and click on the alternatives here, you can see, sure enough, there's the bear market. So we made an 11% shift in those bear market classified funds. Going further down the list, we got weekly research here. One thing worth mentioning, as you go down this list, those that have been using it are already familiar with this, but those that this is new to you, these little icons over to the right of each of these tickers, they signify whether we're currently long it with a green, whether we're flat with this gray, and if there's any activity this week, a red symbol symbolizes a brand new sell for this week. So we're selling out of Belgium. For all those of you that are using Belgium right now within your portfolio, there's a fresh sell out in that. But going further down the list, we actually do have some of the components of we do have the components of the global equity strategy. You see, we're actually selling out of the EFA position this week as well. So that is something worth noting when it comes to the major markets or the components of the global equity strategy. Scrolling back up the list, going over to Globe at a glance. As I mentioned, we've seen quite a bit of recovery within the BRIC countries. And you see right now, by default, it shows the measure being year to date. All you have to do is change this measure from year to date to this quarter. And this is showing all the data as of last Friday's close. So taking a look here, you see Russia, the MSCI iShares of Russia, up 16.6%. We have India up 3.38%, or excuse me, China up 3.38%. India up 12.25%, and then Brazil up 7.22%. So any advisors that have been able to weather the storms, looks like we've seen some major recovery in these spaces of the BRIC countries. I did take a look at portfolio comprised of these is about in line with the S&P 500. Not that that's necessarily the benchmark you should be using, but it is up around 4 or 5% year to date for these countries. So it'll be interesting to see. We saw last year Russia just slammed, and of course they were doing all the activity that they wanted to with Crimea, not really caring about the market, which is sort of the opposite. We have our Feds that's constantly concerned about what the implication of any sort of activity will be to the stock market here. And we're now seeing that when the dust is finally settled with all this activity with Russia, that the market has been significantly recovering overseas. And let's take a look here. Just revisiting the sectors, as we said before, really it was across the board, just sort of a flat move. We did see some more buying, but it was really negligible when you offset it versus any sales across all the different sectors. Jump into the dashboard. If we go over to 2.0, we can actually take a look at the all stats.
Yeah, you're gonna have to look in.
Yep, not a problem. So again, we'll go over to the research section of 2.0, and then all stats. And as you can see already, Bob, you were right, 69.27% is the current database exposure. And then going down here, you can see the orders for the week. We had 219 entries, 133 exits, 155 entries on the 3.2 with 157 exits. So it was really just slightly positive, but pretty much a wash for the week when it comes to total activity. I don't believe we had any shifts when it comes to any of the sectors. I think we're still long. Yep, 10 out of the 12, still waiting in the other 2 to show some signs of trending on it. Yeah, it's been a pretty boring week to say the least. Ending flat on the week and not seeing much when it comes to rotation within the database. We're just waiting for the market to do something at this point. And as you said, Bob, it looks like we're going to be looking forward to third quarter before we seeing any more activity, because we're certainly not going to get it on the last day of this quarter.
Yeah. I don't know who. I hope Steve Jobs didn't design the mouse for Macintosh. This thing is terrible. I've got to get a new mouse. I'm trying to manipulate some things while Mitch was talking there, and it's yeah. Anyway, like I said, there's so little to talk about. We've got to talk about the Apple mouse here. It's just the database though. Overall, when we start to look at what the database is doing, it's pretty robust because of the 69%. And today or tonight is the day, right, Mitch? We will go in and optimize the database.
Yeah, I imagine we'll be talking about that on Thursday. What I'll do is I'll take a comparison and see what type of rotation we've seen from 1.2 to 3.2 or vice versa, depending on how things pan out.
Well, go ahead. What
that means is, if you're looking at a security, we'll use Netflix as the classic whipping boy. If Netflix had been optimized at the 1.2 system, and now the net profit has creeped above 1.2 on the 3.2 system, the database is going to shift to be optimized to that other trade system for any brand new watch lists or new portfolios. It won't make any changes when it comes to your existing portfolios or your existing watch lists. But going forward, if you create any new portfolios or new watch lists and you go to set the optimized trade system, it is going to go ahead and grab the new the newly optimized trade system on that.
And a lot of times, folks, the fact is that maybe it's one trade that's different.
Right.
There's a lot of times that the difference between 1-2 optimization and 3-2 is not significant. And one of the things I used to talk about years ago and haven't really brought it up, but I will at the moment, is that let's say, for instance, you look at 1-2 and 3-2 and you like the trade locate. They're pretty similar. But the trade, you like how 1-2 or 3-2 trades versus the other one, then you can utilize that. They're pretty similar. There are cases where there's a drastic difference between 1-2 and 3-2, so those I wouldn't change. But if they're similar, maybe a one trade difference or something like that, there's nothing wrong with continuing on with those models. What both models have demonstrated in that test and in that back testing periods and look back is that they are both quite capable of generating profits, and that's what you want. And I have seen times where the non-optimized model is just not even close to how good the other model is, and for one reason or another, and I think it's because of the nature of mutual funds, 1-2 tends to be slightly biased. I think it's about 60-40. We looked at that one day, didn't we mention?
Yeah, it was just slightly. I think it was just shy of 60%, 40%.
So there's a slight bias to 1-2 on mutual funds, and probably the same case on ETFs. I'm not sure about that though. They should be similar in characteristics, but we didn't look at that. But those things are like I said, going to be 1-2 more than not, and I think it has to do with some relative volatility that you get out of indexing versus individual stocks. There's a lot more dynamics on the individual stocks than there is there. So,
I just shifted the screen a little bit. You can see right now we're currently pegged at 51.5% to 1.2, 48.5% to the 3.2 on the optimized weekly.
So guess what? When this thing optimizes, we need to make sure we have those numbers snapshotted.
Yep.
But I bet this thing doesn't change a percentage point. I'd be surprised.
Interesting, yeah.
Yeah, maybe it's going to be point something, but it's not going to be most likely any whole numbers. But we'll see. Because I said that, it's going to be a giant shift, right? That's the way that works.
30% swing or something.
Yeah, exactly. But that's not likely. The only swing that we've really seen in this database over all the years that I've been doing this, going back to 1997, is really the 08 crisis. We saw a shift because of the high volatility. We saw a shift. It used to be pretty clearly 60-40, 3-2, 1-2. Have an old white paper that we did back in, I think it was 1998, that we figured out that at that time, in the 10-year look back then, if you just put everything on 3-2, it was better off. You didn't need to worry about optimizing. But as the markets unfolded, as we saw, we've been through two really big downturns with the dot-com burst and then the housing crisis and financial crisis 08, 09. We have seen some shifts in the database, and it's become, because of the higher volatility, that's what's happening. We may start to see some of this shift back to 3-2 over time now if the markets, if we don't see any crazy kind of market stuff going down. So hopefully, Mitch, you have a fair amount of stocks.
I do. I have quite.
Something I didn't do, folks, and I do want to go back. Let's go back real quick. I'm going to go back to TradeStation. Let's look at the interest rates real quick, because there are some things going there I think that are significant that should be discussed. So let me go back over there and get Mitch out of the way here, and we'll. I do want to talk about that, because there are some things going on that I think are significant. There was one interesting thing, Mitch, that we didn't bring up. There was a sale of EFA, I believe.
I did mention that when we were going through the charts.
See, I wasn't paying attention. I was trying to get this.
I brushed right through it, though.
It's funny. I was trying to get the mouse to work, I think. So I was so distracted. I had no clue what you were talking about. But yeah, so I actually, when I first saw that trade, I thought, is there bad data? And I looked at it. No, it's good. I went to several sources, and there's definitely Europe continues to be this weird thing. And matter of fact, I'm not seeing my favorite international chart now. That's interesting. Here it is. I talked about these charts here real quick. Let me open this up full screen so you can see the U.S. markets continue to outpace the European markets. This is EFA, I believe here. Yes, this is the EFA here, and that collapse that it had last week, it went from like 72 to 68 or something on the price. So it did collapse. It was an appropriate sale of that asset. So now all of a sudden the global equity strategies are back 80-20. As it turns out, they're pretty close to it. And so this is the emerging is not as dramatic as it was in the EFA. And I put these charts out several weeks ago. We started discussing these, looking for the U.S. market to start to underperform. That doesn't look like that's going to happen anytime soon. This would be a great spread trade when it happens. Matter of fact, it has been a great spread trade to have it on the other way, long the U.S., short the EFA. This is long the EFA, short the U.S., and it's not working well. So when this chart starts to, this is actually the EEM, the emerging, but when these charts start to work, that's going to tell us that we're probably going to finally see a top in these markets. So it doesn't mean just when the second they turn up, but we're going to have to see a pattern form that will indicate that these things are going on. So I said I was going to go over to treasuries. Want to do that real quick here. I'm going to take the indicators off here, and we're going to bring up the treasuries. This is a weekly treasury, and we talked about this last week. We got up to the 265 level. Now we're back at 252. So the market continues to have a lot of resistance overhead. Whether it's the Fed continuing their purchases, whatever's going on here, there seems to still be enough cash flow into these treasuries and to bonds in general. Because if you look at some of the activity in our database, we're pegged. We own a lot of bonds, and it's been appropriate to own those bonds, and those trends are still in place. So there's not very little that has changed that, and you would not have thought counterintuitively that we would be owning a lot of bonds. And even going to some of the commentary that I had on the annual report, annual outlook, was that expected for a second quarter for rates to start to spike. They were looking down in the first two quarters. Well, we've done that, and now that we're entering into third quarter tomorrow, actually, we'll start to see if we start any kind of characteristics going on. But right now, negative 5.6, negative 2.8, and then negative 0.9. At least two of the three PPMs are negative in trend mode, which will keep this thing in check for some time, for weeks to come. So certainly, and the other side, and I think the equation that you have to figure out is what's going to happen when these rates do start to rise. And I actually think unless there's some event that has changed market sentiment completely, that this will not be an issue. And I've talked about this number many times on the show, is the 303 number is the number that everybody has in their head, that it's going to be an uh-oh moment when that happens. And maybe uh-oh happens before, as people start to perceive it will happen. But for now, that's not even in the cards, especially with these kind of trend numbers. These are in the opposite mode of the market itself. If you recall, we're 0.52 positive on the S&P on the PPM1. We're minus 5.6 on the downside on the Treasury. So they're completely opposite trends right now, and they're acting, I guess, the opposite, where the Treasuries are staying down with a downward bias and the market's up. So for right now, that appears at least what to be going on, and really haven't looked at any of the other stuff out there. I haven't looked at my FXY for a while, and it really helps if I get the right symbol here. The yen trade that I was talking about several weeks ago continues to be very much like watching paint dry, but the consolidation, the bias is starting to turn slightly up. We're starting to get above the moving averages, so I expect over the next several weeks we'll see the yen start to move higher. So, okay, Mitch, with that, let's go ahead, bring Mitch on for a second. So what kind of stocks are we gonna go through today, Mitch?
Well, we got a whole hodgepodge. We could take a couple different routes. You mentioned Barclays overnight, so I thought it'd be good to start there. Talk about what's going on with that company and the prosecution in place on that. Have a couple of different pharmaceutical companies that just got approved by the FDA that I thought might be worth talking about. And from there, we have the other stocks. I did find a list of some of the best performing stocks according to CNBC. Not sure it's the exact article you were referencing, but I do have some stocks that go along with that.
Yeah, I think it was 25 stocks that you shouldn't have missed or something like that. Anyway, that's all right. So let's go ahead and go to Barclays and take a look at this thing and see what's going on. What's that symbol in this?
You want the ADR or the ADR is BCS?
Yeah. There we go. What symbol or what model are we on this?
3.2. We're currently flat the position.
Yeah. So interesting. I'll try not to get politically here. I'm gonna.
Unlikely.
I have to tell you that it's when you see what's going on with the banking system. So the government bails them out. And then they give them the money, they get them all healthy, and then they're penalizing them. So they didn't penalize them up front. It's kind of interesting. Maybe it's appropriate. So, but they bailed them out. They got them back whole. They got them to reconfigure the banking system. Now they're back. Now they're attacking them for all these little things, and it's billions of dollars. You look at what's happened with Bank of America and all of them, Wells, everybody on the mortgages. So it's sort of like, okay, we got them healthy now. Let's take money out of their pocket to move that out. So I'm not sure. Like I said, I'm not sure if it's appropriate or not. I guess no one went to jail over some of the crazy stuff that happened, which is amazing in itself. But the bottom line is, it appears that we got them healthy now. Let's find all the little places we can attack them and take literally billions and billions of dollars for them, put them in the treasury. So that's at least the game that's going on, and maybe it was the right way to handle this thing. And it's not really talked about a lot, but I keep seeing these things happen. And when I saw the Barclays story go, I go, well, here they go, and they're gonna take the money. And then you look at all the stuff that's went on with UBS and the Swiss and all the different things of tax havens and all the other stuff. So they're closing everything down the best they can. And so anyway, looking at this, good news is we had a nice positive trade on Barclays here. I'm going to get out of the way here for a minute just so we can see what's going on here. And PPMs are real negative, 132.99 and 37 right now. And you can see we exited way over here in October of last year. Market lost its momentum, and it's just been drifting sideways. Finally, now we're seeing it start to go down. We had a nice positive trade. We bought it. See if I can find. We bought it way back in on 622 and 12 at 12.26, and then we sold it at 17.01. So a nice. I don't know, must have been about a 38, close to 40% gain, right, Mitch? Something like that.
38.825%.
Wow, that's pretty good.
Nice job.
I'm going to have to, it's funny. I always tell Mitch about having been a floor trader for years, we had to use our memory, and there was a time when we didn't know what our average trades are, but I can look at numbers and come up with these crazy percentages and know exactly pretty much where I'm at just by looking at the numbers. And I guess it's that magical mind of, I guess when I start to lose that stuff, folks, I'm going to get concerned. I have to tell you, it's always been something I've had this knack. And there's actually a great book called The Metal Men. It's an old '80s book, but it was really it's a book on Mark Rich, who Clinton pardoned. But he was a commodity trader, and it's about Solomon Brothers and all that. There's some pretty interesting old stories out there, but I guess we won't do story time right now. Let's go to the next stock.
Next stock, I actually did steal this from the list. I found the article at CNBC. Hope you own these 11 stocks.
Oh, 11. There you go.
This quarter. One of them that jumped out to me is pharmaceutical VRTX. They just got approved for treatment on cystic fibrosis treatment. And that's something that has a little bit of a personal impact. I have a history with that in my family, as well as some close friends of ours lost a brother to cystic fibrosis this past year. So
what model is that on?
That model is... I just lost it. Bear with me 1 second. Right now we have a buy order on the 3.2 weekly.
Right.
And that is the optimized trade system. Actually, I think both trade systems are going long it today.
Okay.
So yeah, they just got approved by FDA for 2 new drugs.
Yeah, interesting pattern. The last time we caught it a little early before it ramped up, then we got out, it drifted lower, and we've had this stock has done it again. So this time we get the blast out, and on Friday last week this news was out last week or something.
Yeah, I believe it was last Thursday that the news was out. So
yeah, it looks like it here, and yeah, so we've seen the move out of this pattern, blasted up. It went from 74 to 90 something. What was the range here last week? Can you look at well you've got the other screen in the background there?
Yep.
Can you look and see what our returns are, our normal returns on this when it happens? And this will be a lesson, I guess. If anything else, we'll see what happens. But we went from a low of 64.
Yeah, it was 66 on Monday. It opened up at 93 on Tuesday is when they announced it, not Thursday.
Okay. And so what's our normal?
Let's see. Average gains on this are 67%.
Okay.
And let me see.
So when we went from 60, how much of that did we already achieve on those few days of that blast? Probably about half of it, huh?
Yeah, half of it right away.
Yeah. So one of the things that there's no way to determine, I guess, what the stock's going to do. But when I see a big ramp up like this, whether it has the same pattern, the last time it did this before, the stock seems to do jumps. There's even a pattern further back that is. Let me go full screen on this and see if I can go back even further. Yeah, it's interesting. This stock tends to have a party one day, 1 week, and then just kind of drift and not do much after that. And this is a kind of a characteristic. Here's one back in 11, same thing. The previous trade, but we were long ahead of it. But even then, it just kind of drifted. We ended up giving back some of that trade just because it just didn't follow through. And now we got a buy and a sell. We kind of break even, and now we get a buy a little late. I guess if I had this on my screen, I would be questioning whether I want to do this trade, especially after let's call it a 64 to 90 move already. And those are tough to walk into, and I guess this is a good way to feature exactly what you need to consider, especially in an individual stock portfolio. Do you really need to own this one? I guess if you understand this thing fundamentally, and that maybe this particular bit of news is bigger than I understand it, being a technician and not knowing anything about the stock, that maybe there's more to it. The characteristics of how it's traded in the past is what I'm looking at, and I'm not really all that impressed with. If you're in ahead of time, that's great, but if you're not, you're not. And I would be considering probably you're probably halfway through the trade already, really, just because it responded to that change in prices last week. And it's unfortunate that that little upburst that there was prior to this big spike that we didn't pick it up, but it just didn't happen. And I put in, as Mitch pointed out, we have 1-2 and 3-2 buying at the same time here. So 1-2 wasn't able to figure it out. That doesn't have the longer term filter ahead of time as well. So if I had this thing, I'd be a little hesitant about putting it in this morning. I guess about 2.5 hours late on that comment. But anyway, these are kind of things that I would consider. And I know many of you and that are watching this show and we go through these individual stocks. I think probably the biggest thing that comes out of this particular segment when we're doing it is characteristics of the models and how they respond to different elements. And when I see something like this, there's an opportunity for me to point out some of that. So these types of stocks that have these characteristics, maybe we'll think of this again and revisit this thing 10 weeks from now, and we'll be able to look at what happened there. Maybe it'll probably go to 120 now because I said that. But bottom line, even at 120, that would be about what is the price expected? You still have it up there, Mitch?
Let me jump back over to it.
Yeah, so we'll look at the VPM price expectation here, and that will give us I don't know what the gains would be if it's, would you say it was 60 some odd percent?
Yeah, I believe 64%, 67.64%.
And what's the target price? Well, we don't know, do we? Because it just went out today.
Yeah, let me see here. Yeah, because we need
so
information.
So what will happen is VPM will get the trade, and tomorrow the trade profile will be updated to reflect what the expectation is. But 60% of see, the problem is I don't believe that 60% is going to be the number, because that would be maybe 36 $40 gain from here, and I think a good portion of that's already happened. My bet, being a betting man, last time I bet Mitch, I lost on one of these. So, but I would bet that it maybe rallies a little bit, but it drifts. I think the news and the evaluation is probably already in the stock, but we'll find out if I'm wrong. I just think if you're running individual stocks, especially one of the things I think is really critical of, and I know a fair amount of you are utilizing some screening technique, whether it's from us or things that you got from out on the street. But the bottom line is, when you're doing this, you have to understand that the screens bring these things in focus because of balance sheets. And if you see a jump in price like this, then I think you're just better off. I'd rather have my 5% in cash, which is not probably going to make a material difference. And sometimes a trade like this can generate an entire array of other trades if you're fully invested. So now all of a sudden you've got a 24 stock portfolio. You get a stock like this that's probably going to go nowhere, and you have to rebalance the account to make room for it, and maybe you already got 17, 18 long. You could end up with a run of 15, 16 trades or more to get one stock in there that's not going to go anywhere. So from that standpoint, I would look at it. If the stock was differently positioned, then I would do that. And one of the things that happens, now this is probably a Process Warriors kind of comment, but the point is that what happens when you get some of these rebalancing trades can also be good. So what will tend to happen in the early phases, like 2 weeks ago, we had the big buy, and we got a lot of accounts that had rebalance orders and things that happened. It's interesting that things like Global Equity and those things had some rebalancing to do to put these things together. Now we've seen it pull back, which is, I think, good, because what happened is we forced what I call a linear distribution, where everything is kind of rephased and made equal again. So when you're within a trend, you have things that come in early, they'll grow as you get to this point. So that rebalancing has rebalanced the risk and lowered the relative risk in these strategies. So everybody's so darn focused on, oh my God, I got a ticket, I got a trade, not looking at what happens from a portfolio standpoint. This is the virtual portfolio manager that we're doing, and there's some dynamics that occur in these transactions that are good. So to ignore a trade like this, if you just had a rebalance, then you're not going to get any benefit. In some cases, just doing a trade like this can rebalance the risk in a trade, and it's worth doing those tickets. And so I'm on this rabbit trail. I can't get off right now. But the bottom line, what happens here is that when you get on in a sequence, when the markets are starting to expand and these trends are starting to expand, so we go from around 47% bullish to 69% bullish over the last couple months. What's going to happen is you're going to get some of these rebalancing order periods, and it also, not only does it redistribute the risk and rebalance the risk, it also oftentimes in a trend like this, we're taking profits on stocks that we normally would be waiting for the market to go higher and roll over. So it takes some of the profits and redistributes that money back into these trades. So there's a lot of dynamics that are going on from a portfolio standpoint that are really, really positive for walking forward the process. So whenever you make a decision, well, I'm not going to do this order, do that order, I don't want to do all these orders, you're actually taking away from the process and probably taking away monies from your clients and not taking advantage of what we're doing. You can't focus on just the tickets. It's about what's going on within the dynamic process of being involved in a portfolio. I couldn't stop that one. Sorry, folks. I got onto that flow and I had to go on. But this is really important because this is really the essence of what we do. People get too tuned into this trade. That one was a winner. That one was a loser. When you're not even looking at what's really happening in portfolios, because maybe you don't understand some of the things I just discussed that's going on from a dynamic standpoint. So there's every trade. That's why we did those trade impact charts. Still, if this is the first time you watch this show, go look at the trade impact charts, because those just aren't looked at enough to understand. That actually really shows you exactly this scenario that I just painted out and went on to this little ramp page for I don't know how many minutes. But it's important because this is what we're doing. So I actually got us all the way into like 4 minutes to the end of the show on that one.
There you
go. So, but there was a lot of benefit, I think, if you were fortunate enough to hear this. There's a lot of wisdom from a portfolio viewpoint to take to the bank there. So next time a client goes, gee, we just got this, did that, and now we got all these orders. How come we did all these orders? Well, that's why. We're rebalancing the risk. We were doing this is part of the process. It's like, welcome to the Jimmy Dean sausage factory. I always say you might like Jimmy Dean sausage. You probably don't want to see it made. And when you're doing SMA accounts and you're doing this type of thing, you're going to get that type of activity. So anyway, sorry for the rampage.
No, it was good. It was good. Just a side note, those trade impact charts will be updated by end of day close tomorrow with the updated information for this last month. So
so we do those monthly, right? Yeah. There's really no point other than monthly.
Right.
Actually, that's why they're done there. But yeah, they're important, folks. It's important to understand. And like I said, everybody focuses, we bought here, we paid higher, we do. That's not what it's about. This is about a portfolio dynamics. There's another element here. And whenever you decide to do your own, we're just going to do 5% in each stock and all that kind of stuff, you're missing the effort that I put over a year of my life into, and to understanding how to dynamically rebalance portfolios and get money to accelerate when you're in a portfolio. By rebalancing and doing some of these techniques causes the money, actually the velocity of the money growth, to go faster. That's what I thought we were trying to do when I built this. That's such an important fact to understand. So a minute and a half to go, Mitch. What do we got to close the show before we move on to Friday and off to fireworks, or on Thursday and off to fireworks on Friday?
Well, I have a couple other stocks. Obviously, we're not going to have time for that, I don't think. But
no, we're done.
Keep your eyes out.
You got less than 60 seconds.
60 seconds.
Yeah.
Keep your eyes out for updates to the Premier fact sheets as well. We'll be running those this week. So we'll be starting our normal month-end process that'll keep things pretty well busy on my end, that's for sure, as we're clicking through them. And then otherwise we'll see you folks on Thursday for the next Market Thunder.
Sounds good to me. All right, folks, have a great day. See you Thursday, and we'll see how this week pans out. Hopefully better than today, up 0.52 at the moment. Anyway, folks, thanks again. Have a great day. We'll talk to you soon.